And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani here. Now, we've heard about this retail investment frenzy recently in stocks and even in ETFs. We've been tracking Robinhood and what they've been doing here. Now it's time to hear from one of their competitors, I think it's fair to say. Dan Egan is the Betterment Director of Behavioral Finance. He'll tell us what Betterment investors have been doing and try to explain the psychology behind all this sudden investor frenzy. And we've also joined by John Davi. He's the head of Astoria Portfolio Advisors, a regular here on ETF Edge. He'll tell us why value might be outperforming in the second half of the year and the ETFs he's using to do that. Dan, let me start with you. We heard a lot about the Robinhood crowd and the surge in interest in retail trading recently. Those metrics were fairly easy to see because Robinhood posts them. Tell us what Betterment investors have been doing the last 3 or 4 months. Have they also been trading a little bit more? What were they trading if they were?
It's an interesting time to sort of be able to see this going live. I don't think I've ever seen a market quite like this one in terms of what's driving each person's specific actions and what's happening. So just, to set it back, this started, say, back in March. In March and April, we were definitely seeing people getting a little bit more conservative, especially around having cash positions or emergency funds and wanting those to be available at shorter notice. We actually saw greater activity around our cash savings accounts at that point in time. Since then, as things have stabilized and people have ended up staying home a lot more, I think there's been a depression of how much people would spend. No going out to restaurants, not a lot of activities, indoor activities they used to do. And people are either voluntarily or involuntarily saving a lot of that money, and they need something to do it. And, I've definitely hit the end of everything that I can watch in my Netflix queue. We're starting to see what I would call entertainment investing, where there's no professional sports going on. There's not a lot that you can talk about. That's sort of like a communal thing for us to all focus on and understand what's been happening. But the stock market is in the news. People talk about it. It's more accessible than it's ever been. So we are definitely seeing people treating it a little bit like a form of entertainment, where they want to come in and be able to talk about what they have and haven't invested in, how it's been doing. So I think across the board, both from a sort of budget point of view, but also from a what else are you going to do with your time point of view, it's been a good time to be somebody who helps clients manage their money.
John, I love this phrase from Dan, entertainment investing. We always have Dan on to talk about behavioral psychology, but that's a new line, entertainment investing. I think that makes a lot of sense. From your point of view as a professional investment advisor, what do you make of this recent retail frenzy? Or are we making too much of it? Is it just limited to really just a few bankrupt companies and a few airlines? What's your take on all this?
I do think that it is limited to like a specific cohort of stocks. So either stocks that have very low price. I think a lot of retail investors that kind of come into the market, not really for a long-term strategic allocation, tend to buy very low price stocks, penny stocks. It is concerning. I think investing, you should have a very long time horizon, as I've said on your show many times, Bob. So I am worried about it. I do think that as the economy opens up, sports opens up, a lot of these investors that would typically trade, for a quick day trade, I think they will go and find other ways to kind of utilize their efforts and their time and their money. Yeah.
John, I want to go back to this. I love this line, entertainment investing. You shared some stats with us for Betterment up through March. More customers making deposits than withdrawals. Call and email volumes 50% higher average in March compared to January. Do we have any updated stats at all? Do we have anything what's going on in April and May and parts of June? I presume you're seeing the same elevated levels.
Yeah, I think they continue to be slightly elevated. Nothing that sort of makes us anxious. We definitely, like every advisor, think that when there are kind of scary events in the news, especially around tax time, that's the point in the year where most people are thinking about these things anyway, that's sort of when we need to step up and be able to talk to our customers more, communicate exactly what's going on with them. I think that things have been elevated throughout this, both because people are trying to wrap their heads around what is the right thing for them to do financially. We had a whole bunch of legislation passed that was meant to help with people's finances, specifically in regards to COVID, withdrawals from retirement accounts and understanding exactly what the consequences of those were. So I think that for a while, we are going to be on a slightly higher plateau of thinking about, worrying about, looking at your investments and kind of being aware of it, not necessarily only from the entertainment investing point of view, but also from the like, am I making the right moves for me and my family based upon the opportunities that are out there right now?
Yeah. And again, I want to remind everyone, Dan is the director of behavioral finance for Betterment. So he's sort of our market psychologist whenever we have questions about behavioral psychology or behavioral investing. And Dan, just to summarize why you think all of this retail trading happened, I know you used the word entertainment investing, but you used the word more accessibility. The market is more accessible. And I think that's true. It's certainly easier to trade on your cell phone now than it was 11 or 12 years ago. Was there other factors involved? Did $0 commissions? Some people feel $0 commissions was a factor. Some people obviously feel just staying at home. Some people feel willingness of people to bet penny stocks. But, you know, I don't recall having the same frenzy in penny stocks in 2008 that we saw today. I'm trying to think if something is different now, or whether people are just naturally, who have a little money and are bored, willing to throw out, you know, a little risk money and play the field here.
I'd say there's one kind of like real amplifier that's the elephant in the room that we don't talk about as much, which is basically like social media and social networks. And there's a key thing here, which is that we don't tend to brag about the fact that we lost $15,000 last week, or we made a really bad mistake, or something went awry. When you talk to and hear from people, you know, like if you go on to forums like Reddit, where people are talking about how much money they made and how easy it was, we all tend to brag about how easy it is to beat the market. And there's a real sample bias in what most people are going to understand goes into that investing. And I think a lot of brokerages, a lot of places like are very happy putting out figures that reinforce the idea, this is fun, it's fast, it's easy, you should be doing it too. But there's some real sample bias there. People can easily get the idea that this is really easy. I think there are some other interesting narratives out there right now that make you feel like a dummy in terms of the supportedness of policy. The idea, and I want to be clear, I'm not sort of endorsing this, but there are narratives out there that say like the Fed's going to come in and buy no matter what. They are not going to let companies actually go bankrupt. They are in such a sort of like protection point of view that you are a fool if you don't buy the companies that are losing in money. And amongst sort of novice retail investors, these narratives make you feel like it's an easy win for you to go in, trade a couple of like low value stocks that have recently fallen, and that you're guaranteed to make more money and beat the stock market and be able to brag to your friends about it.
Yeah, that makes a lot of sense to me. I mean, we saw this with Hertz. We were really scratching our heads trying to figure out, Hertz is in bankruptcy. Normally, a bankruptcy company, normally the common stock will be worthless. And when it's trading, the bonds were trading at 40 cents on the dollar. That tells you even the bondholders that are ahead of the common stockholders don't think they're going to be made whole at all. And yet the stock went from 40 cents to $2 really quickly. It's hard to like understand the psychology there, because it seems like investors either are day trading just in and out, or they don't quite understand the mechanism involved in bankruptcy. I mean, at what point does their cleverness become just ignorance?
Yeah, I mean, I think ignorance is a good way of putting it, in a very like benign way. Like when Zoom, the video conferencing company, was obviously going to do well because of all of the work from homeness, a different company who had a similar ticker was the one that was going through the roof. So I think there's a lot of shooting from the hip, a lot of people not really doing a lot of research and understanding even which company is which that contributes to this.
Yeah. John, you're our markets. Go ahead, John.
No, I think you also have to factor in that, you know, the Fed has anchored interest rates near 0%, so it's kind of forced people out the risk curve. So people, if they can't make any, make any interest on their, on their cash at the bank. I mean, I started my career in 1999. I remember tech stocks going up 1,000% in a year, but Fed funds, 2 year they were north of 5-6%, right? And that was risk-free, whereas now it's zero. So I think that's also a big catalyst to get a lot of people, not, taking their money out of the bank and going in the stock market.
Yeah. Yeah. John, you're the markets guy here. You have to recommend investments all the time. I know you have said for a while now that you think value / cyclical names would be doing better in the second half of the year, and you also like small caps over big cap, particularly big cap growth stocks like the mega cap stocks. You still believe that? You did last time I chatted with you. And what ETFs do you like for the second half of the year? Can you give us some names that you think will outperform?
Sure. So, we run some long-dated retirement money where our time horizon is 5-10 years. So I think, small caps, if you look at EES, the WisdomTree earnings weighted small cap ETF, you have a 9 PE ratio. That's versus the Russell 2000 ETF, the IWM, which is 14 PE ratio. So that, Bob, to me looks very attractive if you believe that there's a cyclical upswing in the economy and that we're past, the recession period. U.S. large cap index is, north of 20. So, the entire U.S. market, I would say, looks, interesting once you strip out, things like SPY, SPLV, USMV, all the defensives like XLP, XLU, Cape-Shiller PE ratios in the high 20s. So I just think that if I look at the macroeconomic data, the earnings, everything looks like it has, troughed. So with the Fed anchoring interest rates at zero and they provided the floor to financial assets, they're going out and buying individual bonds and ETFs. I just think that, now is the time to strategically rebalance your portfolio.
Yeah, it's a nice in theory. The problem I have with the whole thing is I don't like value versus growth in general. I think it's an outdated investment ideology, but it's a loser, John. It's been a loser for 10 years. Now, I know you can argue on mean reversion, I guess, but, even our friend in Omaha is having a lot of problems around the whole it's time to buy value story. Is your call to buy value, but by the way, value, in case you're wondering, folks, right now is generally energy stocks, a lot of bank stocks, some retail stocks. Is your call, John, to buy value really an idea that the economy is recovering, and so instead of a late cycle play, we've already gone through the recession and now we're in an early cycle, and so you should buy cyclicals in an early cycle play? Is that the rationale here?
Yeah, and it's all how you construct the portfolio, Bob, and how much risk you put in one particular factor. We tend to be more diversified across factors because we don't want to make a big value bet. Casing, as you just said, 10-year trade, it's gone wrong. So we've been on your show many times, and we've been fortunate. We've said tilt towards, quality, tilt towards high-quality growth. So what we're saying now is that, now it's time to take profits. The idea is to buy low and sell high and buy, when valuations are on the low end. And I do think that, if I look at emerging markets, if I look at, things like MCHI, MSCI China, 12 PE ratio, the broader emerging market ETF that we use, DGRE, has also like a 11.5 PE ratio. Yeah. So to me, I take comfort in that. U.S. large cap index, like I said, the forward PE ratio in the low 20s, that's, very, very high in my eyes. Doesn't mean that it can't stay high forever, but, as somebody that strategically thinks very long time, I do think that it does make sense. And the banks that you mentioned, we have the KBWB large cap banks. I mean, to me, that feels like, a regulated entity. You've got very strong balance sheets. I think banks are well positioned. So as the yield curve, moves, steepens, and as rates go up, I think, banks should be a pretty interesting 5-10-year trade.
Dan, how do you explain to Betterment investors all of this? I guess you'd call it factor investing, quality versus low quality, or value versus growth, or low volatility versus high volatility, or momentum versus low volatility. Does any of that, as an investment category, I guess you call it factors broadly, make any sense to you? And does it fit anywhere in the Betterment universe? I'm just, Dan, I think we lost your audio, Dan. We'll see if we can get Dan back up. Oh, there you go. I'm sorry, Dan. Did you hear what I asked you there?
Yeah, absolutely.
Go ahead. Finish your point.
So one of the things that we've really focused on is positioning the investments and the investments that we put forth for clients as being about them achieving their goals. And over the past 2 or 3 years, outside of our sort of vanilla market cap-ish, globally diversified portfolio, the fastest growing and the most sustainably growing strategy that we've been putting out there is our social responsibility strategy. And I think that, like it's something we offer. It's not something that we market dramatically, but we make it available to our clients. And without that marketing, without a tremendous amount of trying to push it in front of people, it's done very well. And the events of the past few months have driven more interest in that, more interest in the value of what you invest in from a values point of view. And I think that there are big opportunities now to say, how can we more refine and reflect the values of our clients in the investments that we provide for them? And that not only allows them to sort of feel like their money is going to places that they, feel, I don't know how to put it, responsible with, but also when you are invested in a portfolio for ethical or moral or any kind of like more fundamental reason than money, you tend to be a better investor in it. You're less likely to panic during downturns. You're more likely to stay the course, save reliably. Yeah. So I think that when we tend to talk to clients about value and values, it's just a very different conversation about what do you want your money to achieve.
Yeah, that's a very good way of looking at it. And when you say socially responsible, are you just talking about ESG, like plain vanilla ESG? What does socially responsible mean to you? What are they actually investing in when you say they're interested in social responsibility?
ESG is definitely the broadest framework. It's also the one that sort of right now has the most assets and therefore the lowest costs associated with the funds in it. I think one of the opportunities that we're looking at now is that different people have different values, and the ability to let each person reflect themselves in their portfolio in some sort of a scalable fashion. There are funds out there. There is a fund, NACP, that specifically looks at the advancement of colored people. I think that there are more opportunities to refine the niches that people really want to see reflected in their portfolio. I'm not sure if that's going to be a fund in the end of it. It might require something that's more like personalized indexing solutions at the individual stock level. But I definitely see that being a growing and a real growth area for any advisor who wants to have conversations with clients about their investments that aren't just what did it do last quarter.
Yeah, I think that's a very good point. And we had the head of the NACP ETF on last week, and I think you're right, Dan. What we're going to see is ESG is a very broad area for socially responsible investing, environmental, social, and governance. And I think you'll see the emergence of, I wouldn't call them more niche-oriented, but stuff that's a little more geared towards trying to attain a specific goal, whether it's clean energy or whether it's social justice. I think you're going to see much more interest in that. This has been a very fascinating conversation. I know we sort of veered off into philosophy a little, but Dan's here, and we often have Dan on to try to explain investor psychology and unusual trends in investor psychology, and this is certainly the right time to have him on. So thanks very much for that. And that does it for this week's ETF Edge here. I'm Bob Pisani, and my thanks, of course, to Dan and to John for joining us today. And thank you for watching, everybody. Fascinating conversation. You can find all of our latest videos, as usual, right here on our website, etfedge.cnbc.com. We'll see you all next Monday, same time, same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.